Hello students, this is Miss Mishu and this is an introduction to Chapter 5 for Accounting 1, Transactions that affect revenue, expenses, and withdrawals. So the chapter objectives, our students will be able to explain the difference between permanent accounts and temporary accounts, list and apply the rules of debit and credit for revenue, expense, and withdrawal accounts, use the 6-step method to analyze transactions affecting revenue, expense, and withdrawal accounts. Test a series of transactions for equality of debits and credits, and define the accounting terms introduced in this chapter. Okay, so owners need revenue and expense information to keep the business on course. You need to know the money that's coming in and going out of the business. Remember that the revenue or income earned by the business increases owner's equity and expenses decrease owner's equity. An informative way to record transactions affecting revenue and expenses is to set up separate accounts for each type of revenue or expense. Such information helps the owner decide, for example, whether some expenses need to be reduced. The life of a business is divided into periods of time called accounting periods. The activities for a given accounting period are summarized and then the period is closed. A new period then starts and transactions for the new period are entered into the accounting system. Using temporary accounts, revenue, expense, and withdrawal accounts are used to collect information for a single accounting period. These accounts are called temporary accounts. They start with zero balances at the beginning of the accounting period. That's very important. The accounts are not carried forward from one accounting period to the next. So with the temporary accounts, the balances are not carried forward. At the end of the accounting period, the balances in the temporary accounts are transferred to the owner's capital account. Now I'll show you an example of that on the next slide. So you remember the rules of debits and credit. So there are rules for expenses, revenue, owner's capital, and withdrawal accounts as well. So remember the left side of a T account is a debit and the right side is a credit. So they are abbreviated DR for debit and CR for credit. So for expenses, the increase side is the debit side and the decrease side is the credit side. And remember, the normal balance is always on the increase side. For revenue, the rules of debits and credits are reversed from expenses. So the decrease side is the debit side, the increase side is the credit side. The normal balance is always the increase side. Owner's equity or capital is the same as revenue. And withdrawal accounts are opposite your capital accounts, which should make sense. So let's take a look at the temporary accounts here. Let's assume you have utilities expenses, okay, which is one of the common operating expenses of a business. So you have the debit and the credit side. So as you accumulate these costs, you have telephone or electricity costs, you will add them up. So on the debit side now, we add $2,857 plus $5,141. That becomes $7,998. So assuming the accounting period is now closed, we need to transfer that over to the debit side of the capital account. All right, so if you had balance in the capital account of $90,000 and you had to subtract the debits of $7,998, the new balance of the capital account becomes $82,002. Okay? There's also permanent accounts. The owner's capital account is a permanent account, as is assets and liabilities. Permanent accounts are continuous from one accounting period to the next. Therefore, the dollar balances at the end of one accounting period becomes the dollar balances for the beginning of the next accounting period. So let's take a look at this on this next slide. Furniture is an asset account. Okay, so let's assume we have a debit balance of $2,875. Okay, because the normal balance of an asset is the debit side. So that becomes the ending balance for that accounting period becomes the new beginning balance for the next. So that's what happens in a permanent account. Okay, so let's attempt to apply some of the new concepts we've learned in this chapter. On page 110, we're going to do the math. You can do this on a separate Word document, Google Docs rather. So a company had the following activity during the accounting period. So we had sales or revenue of $5,000, and then we had an advertising expense of $500, salaries expense of $3,000. Then the owner deposited a check of $1,200, but then the owner removed a computer from the business. The business had to pay $650 for the computer. So what was the total effect on the owner's equity account? So think about what you need to add and subtract from the account. So assume that you have $5,000 from revenue. Okay, so that's a plus. You incur an expense. Are we going to add or subtract that amount? Hopefully you said subtract, so we're going to subtract $500 for the advertising expense. You had salaries expense, so you had to pay your employees. Will you add that or will you subtract that? Okay, so we're going to subtract. So we're going to subtract $3,000. Okay, so now our balance is $1,500. The owner deposited a check of $1,200 into the business. So are we going to add that or subtract that? Right, we're going to add it. So we're going to add $1,200. So now our balance is $2,700. And the business had to pay $650 for the computer. So we're going to subtract $650. So our ending balance should be $2,050. And hopefully this shows up. Come on, there we go. Let me go back one slide. There was a little lag. Sorry about that. There we go. So that is your answer for do the math. Okay, so let's go on to the next slide. And this is problem 5.1, also on page 110. And here what we need to do is classify the accounts, determine which side is the increase side, which side is the decrease side, and what the normal balance is. Okay, so cash and bank is an asset. The increase side is the debit side. The decrease side is the credit side. And the normal balance is always the increase side. Accounts receivable is an asset. The same thing as cash and bank. Airplanes, also an asset. The same information as accounts receivable and cash and bank. Advertising expense, repairs expense, food expense, and fuel and oil expense. These are all expense accounts. So the increase side is the debit side, the decrease side is the credit side, and the normal balance is always the increase side, in this case, the debit side. Flying fees, that's revenue. So that's money coming in. So the increase side is going to be the opposite of an expense, is the credit side. The decrease side is a debit. The normal balance is the increase side. Accounts payable is a liability. And the increase side is the credit side. The decrease side is the debit side. And the normal balance is the increase side, which is the credit side. The capital account is owner's equity. Credit is the increase side. Debit is the decrease side. And the normal balance is the credit side. And then finally, your withdrawals. So can I move this out of the way? Let's just click over here. Oh. So it's owner's equity account. The increase side is the debit side. The decrease side is the credit side. And the normal balance is the debit side. Okay? So that is the answers. Those are the answers, rather, to problem 5.1. And do the math. Make sure you submit your work on Google Classroom. Hopefully this helps you with an introduction to Chapter 5. Thank you and have a great day.